third quarter update. I hope you guys can hear us. If you cannot hear us, please let us know. So before we get into it, let me share the agenda for today. So we will have Chun Siang will ask you the third quarter key highlights. After that, we'll delve into the Q&A, and then please also note that this meeting will be recorded. A quick round of introductions of the management. We have today here Chun Siang, our CEO, Mei Lian, our CFO, Jacqueline, our Head of Investment, Adrian, Head of Portfolio Management, and I'm Alison, Investor Relations at CICT. Okay, now let's bring on Chun Siang to share his highlights. Chun Siang.
Hi, good morning, everyone. Robin already has a question. His hand is up. Or is it they can't hear us?
Oh.
We can move straight to Q&A if you want.
That's, is that everybody's view or is that?
Unanimous? Perhaps then, because actually Chun Siang's highlights will be quite brief. So if just maybe spare us like maybe about 5-10 minutes. I mean, we know you are very enthusiastic.
Okay, 3 minutes.
Chun Siang, please.
Okay, good morning, everyone. Thanks for joining us today. I know you guys are excited to ask questions, so we'll try to spend just a couple of 3 minutes. You probably have gone through the slide deck. I think safe to say this is quite a good quarter in terms of operating performance as well as financial performance. You can see that we are pretty much firing on all engines. Office is doing well, retail is doing well, AEI is getting completed, contributing, and acquisitions are helping to help with the growth of the operating numbers as well as the financial numbers as well. So MPI up about, for the year to date, we're up 0.2%, but that's of course due to the fact that we sold the 31 Collyer Quay. Like for like up about 1.4% on a quarter basis is quite similar numbers. Gearing is up 39.2. I think some of you might be surprised why the number went up compared to last quarter, but it is because of the distribution that we did as well as the advanced distribution that we did as a result of the EFR. So there's a reason why the gearing creep up slightly. Cost of debt, as expected, came down slightly, 3.3%. Bear in mind that this is the year-to-date calculation of cost of debt. So you don't expect it to move by quantum leaps because you are averaging over 9 months, whereas the previous quarter we are averaging 6 months. We did a good financing, 300 million over the quarter. You guys will have seen the news, 2.25%, probably the lowest financing done by the REIT this year. Operating metrics, maybe I'll just quickly skip to the next slide. I think operating metrics, we can talk about it a bit later. Next slide. So AEI, I think we have announced some of this earlier, but we have now started works on these 3 projects already, at least from this quarter onwards. Lot 1, we have gotten commitment from FairPrice to expand into basement 2. This will be a conversion of the existing car park, so that will be a good uplift in terms of NLA and should help contribute meaningfully from next year, toward the end of next year onwards. Tampines Mall, we have already started work. If you have visited, you would have seen some of the works at the entrance area. We will also be moving the works further in once the Isetan exits. We have already got a commitment from some of these key tenants that you see here. So a very exciting list of new tenants that we hope will uplift the overall mall. And then we are also starting work on Raffles City, but this is not really a significant asset enhancement. It's more an upgrade of existing facilities, given some of the facilities are a bit dated and some of the amenities that are lacking compared to some of the newer buildings. For example, end-of-trip facilities, which is common for new buildings now, which is not present for RCT. We're trying to add that as a amenity for our tenants in RC, Raffles City Tower. Next slide, please. I think financial performance, we've talked about that. We're up 1.5% year on year in terms of gross revenue. MPI as well, about 1.6%. So fairly happy with the numbers. So contributions from all areas, from rental reversions, from improvements in occupancies, as well as the acquisitions are contributing to the numbers. Next slide, please. Next slide. I think year to date we talked about it. Leverage ratios and capital management numbers, we've touched on the key numbers in terms of gearing and average cost of debt, so I don't think we need to dwell too much. Next slide, please. I think we don't have to focus on this. Maybe just go to the rental reversions and occupancy. Next slide. Yeah, maybe just a quick one on occupancy. I think all of our assets are doing well, both all in Singapore, Germany, as well as Australia. Office occupancy has improved due to improvements in Australia as well as Germany. We have leased out some additional space in 100 Arthur as well as MAC. So that's a very positive news for us, given the lack of momentum over the last few quarters for leasing for some of this, and now we are seeing some green shoots. So we are very happy with the outcome. Integrated development occupancy came down slightly due to mainly Raffles City. It's a accumulation of a few different buildings, so it adds up to about 0.5%. Due to Raffles City Tower, as well as Funan, there are some exits, but we have already backfilled some of the spaces and are continuing to see some momentum in terms of backfilling. So I don't see that as a major concern. Thanks. Rental reversions, very pleased to say that improvements against the last quarter. If you guys probably have seen the numbers already. If you look at it compared to second quarter, these numbers are up compared to last quarter. Last quarter overall retail, we are probably up 7.7. Now we're up 7.8. I think the more meaningful number actually is office. Office is up 6 point. Rental reversion is 6+% compared to 4.8 last quarter. Thanks. Retail sales, very positive quarter. So I think as we highlighted in previous briefings, I think second quarter was a bit muted, partly due to Liberation Day, right? We was feeling the effects of that in April and May. So we had a slight, excluding ION, we had a slight downtick in terms of tenant sales, but now it's back up about 1% per annum year-on-year growth if we exclude ION. If we include ION, of course, there's a more significant growth rate. So I think overall it does look like the momentum is swinging back to positive. So very pleased with the outcome as well in terms of operating numbers. Okay, next. Some of the new brands, I don't think we want to spend too much time, but I think if you have visited some of our malls, I think we have quite a lot of exciting brands. Hai Kah Lang, if you have gone to Funan, you'll see that every day there's a long queue there. Legendary Hong Kong and Japanese Mall doing very well. Some new brands and some of the others. Okay, I think it's probably not your focus. Maybe just one last slide. This is the improvements in occupancy across the 3 countries. As you can see, we are indeed improving the occupancy as what we promised. I think we wanted to improve the asset performance for some of our overseas assets, and we have delivered on that. Germany is now up to, we leased out a major space in MAC, which has been quite stubborn. So now occupancy there is about 86%. And bear in mind, this still excludes Galileo. So if you include Galileo, that number will probably be a little bit higher. Australia, we also managed to lease up. Actually, the only challenging asset in Australia was 100 Arthur, so that we have leased out quite a big space over there. So now that moves the average of the 3 buildings up from 88 to 91.8%. Okay, sorry, I think that's probably more than 3 minutes, but maybe we can move to Q&A.
Okay, thanks, Choon Siang. Before we jump into the Q&A, just a few housekeeping rules. If you have any questions, please hit the raise hand button. And when you are called, please unmute yourself and ask your question away. But if you prefer, you can always drop your questions into the chat box and we can pick it up from there. I see quite a few raised hands, but perhaps then we will go to Mervyn. Yeah, Mervyn, please go ahead.
Yeah, congrats, Chung Xiang and team. Very good business update. Can't see many negatives per se. Can you touch on the tenant sales? It's FCC also reported improvement. I'm just wondering what's happening for third quarter, and do you think this will continue into fourth quarter, considering the last two December's been down year on year? And the second question I have is in terms of cost of debt guidance. Noted they did fall Q on Q. Do you have updated guidance for year end as well as FY26? Thanks.
So I think I think that I would say that Q2 is more an anomaly. So we are back to normalized pattern. I mean, going up, normally you wouldn't have been so excited if we tell you tenant sales are up 1%. I think you will see that as business as usual. I think it was because second quarter we were down and now it looks like an uptick. But I feel that second quarter was more an anomaly because of Liberation Day. There was a lot of caution thrown into consumer spend. So I think some of that savings that people locked up in second quarter might have contributed to the uptick in third quarter. And of course, if you look at year-on-year, 1% growth means that the third quarter sales was higher than 1%. So it's quite strong momentum. I think part of it was also contributed by CDC vouchers, right? Because those went out in July, but probably did not account for that full delta. But in fact, we probably saw an increase overall across most of the trade categories and not just supermarkets. But okay, so I think our second part of the question is whether we can see that continuing in Q4. I think that's a bit hard to extrapolate. It always depends on how much time people spend traveling outside of Singapore. I think that's always a big determinant of whether a lot of the spend retains in Singapore. Sorry, probably doesn't answer your question on December numbers.
No problem. Yeah, just wondering your thoughts. Yeah, a lot of negativity in the retail space, but I think this is a positive data point. Irvin doesn't need to keep writing on LinkedIn about how great retail in Singapore is.
I mean, negative news always gets more eyeballs. That's all I can say. So don't always believe everything you read in the newspapers.
And the cost of debt.
Look at the macro numbers from DOS, right? I think the retail sales numbers are actually up in third quarter quite a bit as well. So it's not just limited to sales in malls. I think overall, macro across the country, retail sales are up quite a bit. I think, if I'm not wrong, it was about, I remember it was August or July, up about 4 to 5%. Yeah, I think August, 4.6% retail sales.
Then there was a question of cost of debt. Yeah. So the averaging down of cost of debt Q on Q is that we're actually seeing a lower cost per Q. We need to be specific. It's close to about 3.17. So guiding towards the end, we continue to see the cost of debt sliding down. Yeah, but to the nearest decimal point is probably close to 3.3. It's probably not 3.3, but when we round up to the nearest, it's still around 3.3.
Sorry, a bit soft there. So can I say that? So the third quarter itself was 3.17%.
Yeah.
Yeah. Okay. So next year we at least 3.1, if not 3.
Yeah. Closer to 3.1, between 3.1 to 3.2.
Next year. Okay, excellent.
Okay, all right. Next, shall we move on to Geraldine?
Hey, hi, morning, Chun Xiang and team. Yeah, maybe just following on to Mervin's question. If your full loan book resets at today's rate, what could your average cost of borrowing look like?
Oh, well, theoretically, it should be the same as what we just borrowed, which is 2.25%, right?
Oh, okay, so low.
Yeah, technically, I mean, I'm just giving a very simplistic. I mean, we have the capability of borrowing at 2.25% today. So if we reset the whole loan book, it should be there or even lower, because that was a 7-year bond, right? technically our average term to maturity is 4 years typically, because you will have some nearer dated ones and some floating. Floating are usually even lower. So if you actually 2.25 is probably conservative if you reset today, but yeah.
Okay, yeah, it's the lowest rate we've seen in a while. Maybe just on office, if I just look at 3Q reversions, it looks to be closer to 10%. Yeah, so just wondering what's driving the numbers. Is it more Australia, and how much of it is due to the Cap Spring consolidation?
Our reversion numbers does not include the overseas properties, just the Singapore reversion numbers.
Okay.
So
Okay.
we saw some of the leases in some of the properties, like Cable Tower, the reversion number is pretty strong.
Oh, okay. So it's blended plus Cap Spring console.
Yes, there's a bit of a blended effect across the board.
Okay. Maybe just last quick one on acquisitions. Now with Cap Spring already in under your belt, what could be next for us to excite the market?
You're not excited enough?
Very exciting, but more could come, right?
Well, we are looking at a few things that I'm quite excited about, but I don't think I'm ready to share with you. Okay, I think in terms of things that are visible, the only thing we can share, I guess, is sponsor pipeline, right? I mean, those are at least clearly visible. Sponsor pipeline, I think what is left in the books is Jewel. And Jewel is quite an exciting project, but we don't know whether, I guess that's a matter of timing as well. So that's one potential. Not sure whether it's something for 26 or 27 or 28. So we'll see what happens. Also looking at some other stuff, but yeah.
Okay, thanks, Chun Siang. Yeah, very exciting.
I think the other thing that is getting us also a bit excited is also, I think we are trying to do a few AEIs. And I think those have quite meaningful contributions. I mean, they are a bit smaller in terms of capital deployment, but they do add vibrancy, add some new tenants, and also help contribute meaningfully to our numbers on a consolidated basis. We're also exploring new potential AEI for some of the other malls. So as and when they are ready, we'll keep sharing them next year if they come to fruition.
Okay, that's all from me. Yeah, thanks for the color, Chun Siang.
Geraldine, let's hear from Yukia.
Hi, Chun Siang. 3 questions. The first one is on ION. Tenant sales have been very strong. How long can this sustain?
That's not the question. So far, I think so good. I will say that ION sales, if you look at it compared to, I mean, the numbers are up because it's absent last year, right? I think on the year-on-year basis, I will not say that it's stronger than our other malls. I think they are probably more in line. So actually, they do trend quite similarly to some of our downtown malls. So I won't treat ION sales as separate in terms of trending. They still remain quite correlated with, for example, Raffles City, Bugis, or even some of the suburban malls. Even though we see it as slightly higher end lux and maybe slightly higher tourist content, but I think at the end of the day, it's still about 70% domestic. So it's still highly correlated with our domestic traffic. But we are hopeful that the numbers will continue because bear in mind, ION is not operating at 100% capacity. If you go to ION today, you will see that some of the shops are still not fully operational because we have been doing a bit of a rejigging, moving some of the tenants and trying to elevate the experience on the ground floor and shifting some of the tenants. So if you ask me on that basis, actually there is some room to grow because if all the tenants are operating, actually you should expect tenant sales to improve. And I think if you look at tourist numbers in Singapore, I think ION does have some reliance on tourism in terms of spend, right? If you look at tourist numbers, while we do not have big concerts like Taylor Swift, which contributed quite meaningfully to last year, but the government and tourism board still makes a very good effort. If you look at tourist numbers, actually it's higher. We are tracking higher than last year. So there is still strong momentum. There are a lot of the MICE calendar is very strong. And bear in mind this year F1 was actually in October, not in September. So F1 numbers on a like-for-like basis actually have not contributed to September numbers. So that you might see some skew and some positive momentum in the October numbers.
Okay, then my second question is on your comment on Jewel, right? What's the passing rent for Jewel? Can you share?
Oh, it's not our asset. I don't even know the numbers.
Then is there anything on the market that right now that is exciting, that is making you excited other than your sponsors pipeline?
I mean, in Singapore there aren't that many opportunities.
Or those on the market are not so exciting in terms of pricing.
No, I think if it's a third party, unfortunately, I think that in terms it could be exciting, but the pricing usually is not as exciting. Because if you have to run through a competitive process, it's usually a bit harder. We also want to stay disciplined in terms of acquisitions. We want it to be exciting, but we also want the price to be exciting also. Alright, it doesn't really answer your question. But we are looking at a few things also.
Yeah, I was just thinking about next year, what's the plans, is it gonna be a quiet year? Because this year has been relatively busy for you from the beginning of the year to date.
Yeah, we hope it won't be quiet. Unfortunately, it's hard to articulate very clearly. If you had asked, if you look back 9 months ago, you probably thought this year might be a quiet year too.
Yeah, because I look at AEIs doesn't really live much to your, it doesn't bring much to your portfolio because your portfolio is so huge, right? You add another 10 million, it's like it doesn't move the needle. Yeah.
Yeah. Unfortunately, it's very hard for us to share things that we are working on unless it's quite finalized anyway. So usually these questions are very hard to answer.
Okay, I'll jump back to the queue. Thanks.
We are excited lah. But in any case, next year actually we do still will benefit from the existing organic, right? I mean, we have only, even for this year, Capital Spring has only contributed 1 month, starting from September onwards. So it will still continue to contribute next year. There are things that are announced already. I mean, while it's not new acquisition, like for example, Leo, it has not contributed for the last 18 months, but we are quite excited that it will start contributing early next year. And this
Okay.
actually, this one is substantial because it's an entire building, right?
Okay. Okay, thanks.
We shall move on to Rachel.
Hey, hi, good morning, Yu Kiang and team. Sorry, Chun Siang and team. Can you hear me? Sorry.
Yes, loud and clear.
Okay. Yeah, I don't know why my video is not working. Anyways, yeah. Maybe just following on this exciting transactions or assets that you're looking at. Is it still Singapore, office or retail?
If we were to look at stuff, it will probably be Singapore for now.
Okay, office or retail, or both?
I think we are open to both, depending on. We are quite pragmatic people. I mean, at the end of the day, it depends on pricing, right? So we are value hunters. We like, as long as we think it adds value to our portfolio, and we think that we are able to acquire something at a reasonable valuation. Yeah, it's a matter of relative to market.
Okay.
Although if you look at, I mean, most people will, if you look at it simplistically, you know that retail trades at a higher yield, right? Technically, it's more feasible and easier to do retail. Of course, the risk is different. So people cannot just look at you solely as well.
Okay. Is Paragon's portfolio still in your this exciting assets or not really?
Oh, I think Paragon, I'm not
Paragon
sure.
REITs.
I think
Yeah,
they
few
are
right.
still for AEI, so I suspect that might take a while. I don't think it's in the. I mean I don't know, but it doesn't feel like it will be in the market in the near term, given that they have to do a AEI.
Okay. But there are other assets in Paragon as well, right? Paragon REIT, ex-Paragon.
I think there's Clementi Mall. They're running a process now, right? I think that's public knowledge.
Okay.
And the other one, no, they only have Marion after that, which is in Australia. I think these are the three assets that they have.
Okay. All right. Then my next question is on Galileo. Now that you have leased up, it's looking good. Are you keen to sell, and is the market ready to sell?
I think we focus on handing over to the tenant first. Actually, it's not completely. While we have started, actually, it's a multi-phase handover. So we will only be completing the handover to the tenant probably come close to the end of Q1, which is another 5 months from 4-5 months. So I think we want to focus on, and when you do a handover, there could be teething issues at the beginning. So we rather try to be a good landlord and sort out all these issues with the tenant to ensure a very smooth handover first.
Okay. But the income from this Galileo will be full contribution starting from end first quarter, is it, when you fully hand over? Is it full?
Yes. No. So it will be staggered. So it will also, contribution will also be based on phases. We only get rent for the area that we have handed over.
Oh, okay. So when should we expect like the full
Contribution,
yeah.
our partial maybe Q1, full probably Q2 onwards.
Okay, got it. Yeah.
We only own 94.9% of the asset. So when we say full, we mean the full contribution from our share.
Yes, okay. And just one last quick one. In terms of ION, I know there's some rejigging. When can we expect all this rejigging to complete, and then we will see some flows in income?
It will probably take a while because we are we are doing a few movements and you cannot do all at one time, So there's a bit of a musical chairs, tenant A move to tenant B move to tenant C. So it will be ongoing for a while. I think at least it will continue until next year. But at least, those that are not operating now, when they open and contribute, then it will be incremental. Yeah, we don't expect everything to open up, together.
Okay, all right. Thank you so much. I'll jump back to the queue.
Next, can we hear from Brandon?
Hey, morning, Chun Xiang. Just want to touch a bit on your asset sales, right? Can you share what's your guidance here? I mean, we have been seeing cap rates compressing quite a bit domestically. So are you still looking to sell? If we do see that, is it more office or retail?
I think we have done some divestments in the last 12 months already. In fact, it's really still within the last 12 months. We've done 2 asset disposals, 21 CQ and the service residence at Cap Spring. So I don't think we are in a hurry, but as you rightly pointed out, it does seem like the market's yields are compressing quite fast, partly due to probably no good assets available for sale in the market, and also coupled with the sharp decline in interest rate in the last couple of quarters, right? So there's been we are looking forward to what Clementi Mall transacts at eventually. But we do think that, the cap rate compression is quite significant. So it could make us reevaluate our portfolio a little, but I think safe to say we are generally quite happy with our portfolio construct now. We do think that most of our portfolio are very strategic and quite core to our business. I would say that if we were to divest, we may want to look at, I mean, I think some of you alluded to some of our overseas assets that will be more meaningful for us to look at in terms of divestment. In Singapore, I don't see us divesting significantly. We could potentially look at one or two assets, but not urgently because they are all yielding quite well. So we will also have to evaluate. So if when they are yielding well, unless we get a very significant uplift to our valuation or book value, it's likely to be dilutive. So we have to evaluate that quite carefully. So it depends on what kind of yield I can get.
So basically at the current 39.3% gearing, you're quite comfortable.
Okay, so 39% is not the norm. Actually, because we did advanced distribution, right? So in a normal quarter, if we didn't do advanced distribution, this gearing would have been lower. So when people compare it to like say a few quarters ago, it does look a bit higher. But we must bear in mind that we have advanced distribution. Other quarters we normally don't have advanced distribution, right? So if you remove that effect of the advanced distribution, the gearing would probably have been 38 plus. But I guess the underlying message in your question is that should we be comfortable with 39+% gearing? I think we would like it to be a bit lower.
Okay, and just one last one, right? For the potential inorganic, right? Would you be keen to look at some of these GLS mixed use with a retail component? Like something like the Hougang Central Mall, because in the past we did see like CICT going for Bedok site, right?
I think we will evaluate all opportunities. So it all depends on how it affects our numbers in terms of whether we have the capacity to do it and whether it's overall accretive or makes sense for us from a portfolio perspective. Yeah, so I think short answer to your question is yes, we will look at all opportunities as long as it's relevant to our portfolio.
Okay. Hey, sorry, just one quick one. Is Cascade Peak considered your sponsor?
No.
No. Okay. Okay.
What do you mean by sponsor? I guess when you sponsor, we mean we have a ROFR to their pipeline, right? Then the answer is no.
No. Okay. Hey, thanks so much. Thank you.
Thanks, Brandon.
Unfortunately.
Derek, please go ahead.
Hi, good morning. Can you hear me? Hello?
Hi, yeah, we can hear you.
Hey, Junja. Hi, good morning. Hey, thanks for the call. Just a few questions, right? Firstly, on acquisitions, right? I'm just looking at some of your peers. I'm not sure whether peer, but gone into suburban Australia. I'm just wondering whether is that part of the world interesting for you, or you still want to focus on Singapore for now?
I think we want to focus on Singapore for now. We still see opportunities in Singapore. So until such time where we think that we run out of opportunity, but for now, I think we still see some pipeline in Singapore. So I think our investors would rather us focus on Singapore for now as well, I think.
Certainly. Okay, got it. And just to also reconfirm, I think previously, we hear from the grapevine that this Bukit Panjang Plaza was on the market, right? So that is off the market already. Just any thoughts on that?
Was it in the market?
Don't know. So no, not in the market.
I just want to make sure because maybe it was there in the market before I joined, so I need to clarify. I cannot answer for those. Well, I think I'm just checking my colleagues whether it was in the market. No, right? We never said it was in the market.
I mean, it was market speculation.
Yeah, I saw the newspaper article also, but I wasn't sure whether it was from us.
Okay, no problem, no problem. Sorry, my last question, I mean, just a quick one, and the results are really good and straightforward. Could you give us a guidance for your reversions, and maybe going to next year? I think my thinking behind it is that, this year you had the consumption vouchers, right, and boosted spending a little. I'm just wondering whether at this moment, are you still okay to push reversions to the same level? Do you think you can maintain?
No, I think we have always said that high single probably not so sustainable. We
Okay.
probably try to target between mid to, about 2% per annum sounds more reasonable, right?
Okay.
I mean, Singapore inflation is also not that high.
Yeah.
Yeah.
Got it. Sorry, just last one. If you think about the ion, the LLC potential, right? Is that still something you're working on? Is there a timeline that you can look forward to convert to LLP?
Yeah, so I think we have, I think at the last briefing, we have also said you'll probably take a long time.
Yeah.
Not to be probably not something that you want to work into your numbers in the short term. But of course, rest assured, at the back end, we are running at 100%, but even when you run at 100% to try to get it, it will still take a very long time. Because, yeah, I will not assume it in the short term.
Okay,
But
I'll
doesn't
leave
mean
it
we
as
are not working hard to get it done.
yeah. Okay, I'll leave that as a surprise. Yeah. Okay, Ken. Thanks. That's all. Thank you.
Thanks, Eric. Next, can we hear from Shen, please?
Right, morning. Can I follow up on the reversion, right? I guess you were guiding for reversion to moderate for some time, but it seems that things are actually improving. So what's actually driving this positive surprise here?
I guess overall Singapore economy is doing quite well. You look at GDP growth, it's been surprising on the upside every single quarter as well. So I guess I think generally equity market is doing well. CDC vouchers, does seem like people are prepared to. When people are prepared to continue to spend, when the market mood it's general market is doing well. What is driving it? I guess, well, we have always said CDC vouchers driving part of it. Some of it was probably due to, like I mentioned, I think Q2 was a slightly lower base, right? So improving from Q2. Q2 was probably muted because of Liberation Day. I think we probably felt it most in April and May in terms of tenant sales. And some of the bounce back is not as surprising actually. And then you probably have some savings, right? Because when people spend less in the last quarter. But I think overall, market and economy is doing well. So you do expect sales momentum to improve.
Thanks. Second question on tax transparency, right? So our forecast is usually 3 years forward. So by saying that we should not factor this in, does it mean we shouldn't expect it to happen within the next 3 years?
Oh no, I wasn't thinking from your point of view. I was thinking from my point of view. My point of view is 12 months.
Okay, got it. That's clear. Thank you.
Thanks, Shen. Jonathan, you're up next.
Yeah, good morning, Choon Siang and management team. First question, for those of us who missed the first 3 minutes, don't mind, could you run through what's driving the higher occupancy for the office portfolio? And then second question, as we come towards end of the year, do you expect sizable revaluation gain when you do your revaluation for December? Do you expect cap rate compression for retail and office portfolio? Which segment would contribute more divestment gain? Would it be office or retail? Thank you.
Okay, so office occupancy went up largely because we managed to lease out our 2 assets in Germany and Australia quite well. So in Germany, occupancy went up 5%, right? Close to 5% because of MAC, which is only a single property. So that was a single tenant, large lease. So we're quite happy with the outcome. Australia, actually two of our office buildings are pretty much fully leased already. It's just 100 Arthur Street. We managed to lease out 100 Arthur Street and also a fairly large long-term lease as well to Flight Centre, which took up quite a big space. So that improved and this is a 3 percentage point increase in Australia over 3 buildings, right? But actually the standalone building was more significant. So these two contributed to the uptick in office occupancy. So that was your first question. Second question is on valuation, right? We do hope for our Singapore assets to show improvements in valuation. As to how much, I think it's hard to say. If you look at some of the other REITs that have year ends in September or June, they have reported healthy valuation uplift for their Singapore portfolio at least. Yeah.
Yeah. I mean, would it come more from retail, given like maybe transaction in the market?
I think it will be both office and retail.
Okay.
You might
Okay.
potentially see more in retail, I guess, because I think office cap rate is already quite tight, right? So the room to move is probably slightly less than retail. And of course, if you look at our performance, reversions, and in terms of occupancy, is also slightly higher for retail. So all of those get factored into future cash flows, right? I mean, I'm just giving like some of the drivers and what could potentially move. So at the end of the day, it depends on how the valuers do their numbers as well. But if you look at broad numbers, of course, retail number seems to be have a better momentum in terms of rents.
Yeah. Thank you for the color. Thank you very much.
Thanks, John. PJ, you have a question to share?
Yeah, hi, morning, Chun Siang. Just adding on to this, Jonathan's question, in terms of overseas markets, do you see that things have bottomed out over there? Do you expect this occupancy gain to sustain, and probably can give some color in terms of incentives for some of these leases you have signed?
Okay, maybe you want to take okay, the other questions I have to defer to my colleagues.
Yeah, so I would say generally the overseas markets, and I will go into Australia first, right? So for Australia at this point, we do see a bit of signs of bottoming out in terms of some of the occupancy vacancy that we are seeing, but we are also at the same time, right, incentive levels are kind of stabilizing by nearing the peak. As for the leases that we signed, I won't go too much into details, but for the 100 Upper one is pretty much in line with what we are seeing some of the newer buildings in the area doing. So unfortunately for North Sydney, right, this point is on the elevated side of things compared to the main Sydney core CBD area. But the good thing is generally what we are seeing North Sydney compared to a couple of quarters ago, the flight to centrality, right, where a lot which has been benefiting the core CBD for a while. We are seeing a lot more inquiries now also coming for North Sydney, coming from some of the Macquarie Park, your Chatswood, and some of these other sub-precincts that is further out. So hopefully some of these translates eventually into more deals in the area. For MAC side, I think it's pretty much in line with what the market is doing. The rent free is a little bit long for the sub-market in Airport District at this point. But at this, we do not really see something that is out of the norm. The good thing about some of these leases is that the commitments are coming quite early. Like Flight Centre, we are already seeing the tenant taking the space early next year.
Okay. Would you say the occupancy has bottomed?
Sorry?
Would you say the occupancy has bottomed out?
We will still see a little bit of volatility in the next few quarters in terms of the occupancy for our assets. Because there will be some exits, but I think right now the momentum in getting them backfilled is actually quite okay.
Okay, got it. My second question is in terms of portfolio, broadly looking at next 3 years, do you have any redevelopment opportunities in your portfolio like Capita Spring or Capita Green, which you see in your portfolio? specifically in your portfolio or even with the sponsors assets combined together, like Clark's assets or CLI's assets, which you can redevelop together in the next 3 to 5 years?
Redevelopment. So for redevelopment is, of course, we do study some of the possibilities in view of some of the things we see in the master plan. But a lot of all these things we have to actually engage the authorities as well as look at what eventual scheme we are getting. Because it only makes sense for us. Most of if let's say we get a very good GFA uplift, but if you look across most of our properties, right, they are trading pretty well. The kind of occupancy and is actually also quite strong. So there must be meaningful upside for us to undertake redevelopment.
Okay. But at this point of time, you don't see any.
We will have to study and see what the market can bring us.
Okay, thank you. That's all I have.
Thank you.
Thanks, BJ. Can we hear from Terence, please?
Hi. Hi, thanks. Chun Siang and team, congrats on the strong results. Can I ask on the office, what drove the stronger office reversions this quarter? I mean, you report on a 9-month basis versus a first half basis. So actually, it is actually quite strong, specifically for this quarter. And how is tenant demand trending? Especially understand AST2 had a bit of a lower occupancy in the first half of the year. So how is that doing?
Well, I would say that generally, if I look at Singapore office market, right, the key trends are still pretty much the same, right? The flight to quality, people are paying for quality at this point, limited supply, and of course we see some of the upgrading demands. Even though generally relocation is still something that a lot of companies are a bit careful because of the capex commitment, and you also start to see like some of the landlords in the market are starting to look at. Especially for the smaller spaces, right? Looking at fitted out suites and fitted out options. For this quarter in particular, we do see pretty strong reversions for 2 properties, mainly Capital Tower as well as 6 Battery Road. It's very hard to say why suddenly, because actually, like for example, if I go a quarter before, these are the assets that probably the reversions on the lower end, and then but this quarter is on the slightly higher end of things. So it's really deal specific rather than anything that is jumping out for as a key driver.
And for AST2, how's that doing occupancy wise? And is that something that we have to worry about?
Yeah, AST2, I think generally that area has a little bit of activities in the past few quarters because we have Marina 1, we also have IOI filling up. So definitely when it comes to filling spaces, it's a bit more competitive. But we are in talks with some of them to backfill. I think we are in some advanced discussion with some of the tenants. Hopefully you can convert them soon. But with some of these supplies and tightening around the area, those who I would say that this will probably give us a bit of opportunity to see a bit of improvement in the occupancy in the coming quarters.
Can you share the occupancy this quarter for AST2?
Just give me a second.
Yeah. And then just ask a final question. For retail side, any concerns on cinema tenants, and maybe could you give us a sense of which segments are doing better, which segments are a bit more challenged?
Okay, maybe AST2 this quarter, our occupancy is actually slightly higher at around 95%.
Okay, great. Thanks.
Yeah. As for the retail, you were talking about retail, right?
Yeah.
Yeah. So for retail side, our good thing for cinema trade is that we are not overly exposed within our portfolio. It's less than 5% from NLA perspective, and generally their rent contribution is even lower. So I think it's sub 2%. From GRI contribution perspective, but so far at least we don't have a real issue with our cinema, and hopefully I think we will promise that next year there's a better lineup of shows, so hopefully it converts with less cinemas around, better shows, hopefully translates to better performance from the cinema side. As for the rest of the trades, I would say generally we do still see for F&B, right, the operators generally are still quite strong interest coming from there. So dining out, has been still quite resilient demand across the board. So actually a lot of the well-capitalized kind of overseas operators are showing quite a lot of interest coming to Singapore. Having said that, I think generally, manpower limitations, wages, cost of supply also means that a lot of all these operators tend to be a bit more strategic in where they choose and also in terms of the size. So we also see a little bit of shift from what used to be a lot of traditional fine dining, now moving more into experiential kind and affordable food. So and I think this trend will probably persist in the coming quarters. You will see a lot more new concepts in terms of food. For fashion side, generally, the fashion retailers are a little bit careful for expansion now, and a lot of them are trying out like the new to market brands tend to look for pop-out space. So actually, there's a lot more inquiries for pop-out where they want to come in, take a space, either temporary or take up even some of these patron space for pop-outs, right? And then they will try to do like a short campaign, and they will see to test the market whether there's acceptance for it, and before they look at a more permanent kind of space outlook. But this quarter, one of the standout performance is actually the hobbies. Generally, the hobbies are doing quite well this quarter. The hobbies trade, so your Pubma, your Action City, some of those they are doing quite well. Last year, if I talk about entertainment, partly because maybe we will have to see how the F1 weekend goes. But generally, if you look at it, last year there a lot of recovery for the nightlife, the entertainment. But year on year, we see the entertainment coming off a bit. This year, yeah, for the clubs and the bars.
Okay, thanks very much.
Thanks, Terence. Derek, can we hear from you?
Thanks, Alison. Hey, morning, guys. Just a quick follow-up on that cinema percentage of GRI. That's for retail, right? So overall, it'll be even lower, right? Sub 1%.
Sorry, Derek, you're breaking up. Can you repeat your question?
No, just following up on Yi Zhuang's answer on cinema operators accounting for less than 2% of GRI. That's retail GRI, right? So overall, be even lower.
This is actually your GRI, yes, retail.
Okay, so it's retail.
Right.
Okay, got it. Cool. And just could I also ask on the occupancy costs for retail, given that seeing a bit of disconnect between the reversions and the tenant sales, what's the occupancy cost right now? And how does that compare versus pre-COVID?
Our occupancy cost, if I compare to first half of 2025, actually it came off a little bit. Yeah, very marginally. But I would say it's quite stable around the mid-17s. As a portfolio.
Okay. Is there a breakdown between downtown and suburban?
Sure. Just if we are talking about all costs, if we are talking about downtown, suburban generally is around 16.5% there, about plus minus that. So you will fluctuate around the area. Downtown is about 18%. Yeah, about
10%. Okay, thank you. And just moving to office. I'm not sure if I caught. Was there a reversion outlook for office in Singapore next year?
Probably around the same low to mid singles, I would say, for 2026 at this point.
Low to mid single digit. Okay, got it. All right, got it. And just lastly on potential acquisitions right now, I think Chun Siang did mention more of a preference for malls for retail. Within that, would suburban or downtown make more sense to you right now?
Hey, hi, Derek. I think we didn't say that. We said that retail yields are higher, but I don't think we have a preference for that. It all depends on the relative value. We are open to both, as evident in our last two acquisitions, right? One was office and one was retail. So it depends on what's the pricing for each of them. But of course, to make the numbers work, retail yields are higher, so it's always a bit easier in terms of that. But we have to look at it from a portfolio construct point of view as well. I think your question is whether is retail. Okay, the thing about Singapore acquisitions and pipeline is, it's always depends on what's the opportunity. So it's hard to. I don't think we are necessarily try to ring fence around a specific area. I think it always depends on the specific opportunity. I think we are more concerned about the locational advantages and whether there is a great catchment and whether there's a great transport node attached to the asset. So these are more important considerations rather than whether it's retail or whether it's suburban or office or downtown.
And I guess following on that, what makes sense to you also is the dominant nature of the mall, right? Let's say if it's 200,000 square feet, that's imminent, that's far more attractive to you.
Yes. Yeah, so I think definitely for us, it has to add meaningful scale. I think not so interesting for us if it's a very small asset and doesn't move the needle for us.
You spoke about pricing as well. I guess could we benchmark against on a per square foot basis, maybe the current assets that you have, some of the more better malls, suburban malls, for example, are 3,003, 3,006 per square foot. So that'll be a number that's more comfortable for you, right?
Yeah, so I think we have to look at a few matrices. One is cost per square foot, as you rightly pointed out, that's relevant. I think the other thing, of course, because it also cost per square foot can vary depending on whether it's a more horizontal mall or more vertical mall, whether there's basement, no basement, that kind of stuff. So I think the other more important metric, of course, is yield. I mean, because at the end of the day, that's the income that we'll be getting. And also the third number that we always focus on is accretion and how it contributes to our overall portfolio. So these are the few things that we typically focus on and try to be disciplined around it.
All right, cool. Thanks so much, Shan.
Next, can we have Terence from UBS?
Hi, good morning. My first question is on tenant sales. Do you mind sharing a bit on the third quarter year-on-year trend for retail? Because it seems a bit flat for 9 months and appears to lag that of peers. And it's kind of counterintuitive because I would expect that you should have gotten the lift from the SG60 vouchers coming in from July onwards.
Yeah, so I think these numbers are year to date, right? So if you look at it from that perspective, this quarter actually is higher than 1%. As to what it should have been, you sound like you are expecting a much larger number.
Well, your peers are reporting somewhere around, say, 3 to 4% year-on-year increase.
Is that for 3 months or is that for 9 months though?
Probably in the third quarter.
Yeah, so that's a difference. That's why I highlighted that this is a year-to-date numbers. But maybe we can share a bit more color. Each one can share a bit more color.
Okay, so for third quarter, right, if I year-on-year, if we exclude, just like for the properties, right, excluding ION, we are also around 3+% for the retail portfolio.
Okay, and perhaps you mind sharing perhaps your thoughts next year when SG60 vouchers roll off, like should we then expect sales to flatten out, potentially even decline?
Actually, I wouldn't think so, to be honest. Because they will offset with at least some of the growth that we see and the broader economy, how it is doing. So I wouldn't particularly say that that on its own will actually really because actually right now we say the SG60 vouchers, probably there's a little bit of transfer effect between people having a bit more disposable income to spend, given that some of the other day-to-day things they already use the voucher to offset. But we also see some of them take the money and travel overseas and spend it overseas. So I wouldn't say that actually next year we will expect this number to really come off.
Okay, got it. And I think in Tampines Mall, Isetan is due to close down November 2025. Should we expect that there'll be some vacancies, or how's the backfilling progress?
Yes, definitely. That one on its own, the space is about, if I'm not mistaken, around 38,000 square feet, right? So as it closes down, there will be a bit of transitional vacancies that we will see. But actually at this point, we have already been in advanced discussion with a lot of the tenants. Some names are already very, very close with some of these names to just secure it. It's already kind of like well backfilled.
Okay, got it. Thank you.
Yeah, we have some because actually there's maybe I'll just elaborate a bit on this, because for Isetan it's actually sitting on 2 floors, the ground floor and the upper floor. So the ground floor, as the first phase of some of the works that we are carrying out, right? Those we have actually largely kind of gotten the name, kind of filled it up. The second floor is the one that some of the details we still have to work through to finalize with the different brands. because it involves a bit of reconfiguration.
Is it fair to say that this might involve some degree of cutting up large plate into small plate, and there's that effect of like positive reversions coming out thereafter?
Yes, there will be a bit of reconfiguration. Some of the floors will definitely be kind of smaller ones, especially the ground floor. You probably see a bit more of that. Net, we will expect it will generate higher income. So basically, the per square foot rents for some of the spaces will be much higher than what it is getting today from Isetan.
Got it. Thank you.
Thanks, Terence. Next, Rachel.
Hey, hi. Yeah, just some follow-up question. In that Isetan rejig, if I look back at your numbers, your Tampines Mall ROI is only roughly about 7%. But now you're cutting up space in Isetan. Should we expect more ROI?
But we have to offset with a slight loss in NLA also.
Oh, okay.
I think the 7% is taken into account everything already.
Correct.
So overall contribution, it has already taken into account the effect of reconfiguration.
Yes.
Oh.
Sorry, if there's a question, yes, the whole projected ROI includes everything.
Oh, okay. All right. And then for the retail leases that was signed during COVID, has that all already been marked to market already? Or do we still have a few more left?
Mostly mark to market by now, yes.
Okay. And on the office side, you said that the key trends are still there. So I'm just wondering, because of the limited supply, are you still able to push rents up, or generally the rents are actually quite stable now as you discuss with tenants?
I would say that at this point, generally as a market, while there's limited supply, we also see that there's actually I wouldn't say the new demand coming in is very strong. Even though some of the leases we have seen recently, especially done at IOI and Marina One, right? Actually, you see big companies who actually took marginally bigger space than what they had previously. So that kind of reflect also within our portfolio. If we see this year to date, right, we actually see a net expansion of space among our existing tenants. So, but a lot of the movements in the market is actually a bit of musical chairs, right? So I would not say that at this point, there will be a lot of I would say it's actually flattish and very moderate growth, rather than to expect a very landlords are really stretching rents a lot. But of course, in some instances where we actually have tenants that moved out, and some of these tenants probably have been with us for quite a while, right? And then some of the new tenants that we bring in, like what we see in CT and what we see in 6 Battery Road, there are those where opportunistically we are able to get pretty strong reversions. Yeah.
Okay, got it. Yep. And the new to Singapore tenants are very, very small now, right, for office?
Yeah, I would say new to Singapore tenants demand not really that much. In fact, actually, if we see startups, there's actually what we hear is that there's a bit of more startups coming from Chinese and Indian companies, right? Some of them also coming through for the tech space of things, and usually some of these smaller setups, they usually either go for fitted offices or they go for those kind of co-working spaces that we see.
All right. Thanks for the color. Thank you so much.
Thanks, Rachel. Okay, we'll circle back to Melvin again.
Hi. Yeah, just a question in terms of the office MPM margins. It fell Q on year. Just wondering what's happening there. Is it the incentives you're having to pay for Germany or Australia? In terms of second question I have is electricity costs. How much you're paying today, and do you still expect further savings ahead? And for 101 Miller in North Sydney, are we getting closer to doing a more substantial AEIs, especially the retail space, or which is connected to the train station, or at least the forecourt to activate the space? Perhaps have a more comfortable BL clock.
Yeah. I'll probably take the last two questions first. And so for Greenwood Plaza, we are having plans to actually do some of the repositioning works for the Greenwood Plaza sometime next year. Some of the plans we are working through, and we are also talking to some of the brands, working with our JV partners definitely. So we do expect to see a little bit, because earlier this year we did a bit of works around the lobby for the office side. So I think the whole repositioning exercise for the office was quite well, as we can see the uptick in the occupancy. Right now, then the next one to focus on is with Greenwood Plaza. With Vic Cross Station completing later part of this year, we also see that there's a bit of a shift in the gravity of where the traffic flow goes. The center of gravity, right? So definitely we need to do a little bit of things to kind of anchor where and what GWP can bring in terms of footfall, in terms of the sales and stuff. In terms of electricity rate, I will only say that in 2026 we probably expect tariff rates to come off what we have currently in 2025. Yeah. And for the the NPI margin for the office side, I think partly came off when we include Capital Spring. We have that little bit Capital Spring's margin on average kind of have a little bit of impact on the overall portfolio, office portfolio. And let's see what is there one offer.
And the NPI margin hasn't been this low for a while. Should it normalize higher over time, or this is the new level? Or the first half was abnormally high at 76.4%.
I would say that actually normalized should be around 74-75% thereabout.
Okay, sure. Sorry, this back on electricity costs, would it be in the mid-20s at this point in time? Going to low 20s?
You mean it's in
the tariff rate? Yeah.
Yeah, it's probably around slightly below.
But it'll be going to low 20s next year, I presume.
Oh, you're saying 2025 or 2026?
2025 going into 20.
Slightly above mid. Slightly above mid. So now we're going slightly below.
Okay, and your electricity contracts, the 1-year contracts, or you do longer term?
Rates. The contract itself is long. It's just the rates is actually repaid every year.
Okay. Okay. All right. Look forward to an exciting pipeline in the future.
Thank you.
Any more questions? No? Okay, so looks like we got everything covered for now. If anything else comes to mind, you know how to get to us. And thank you for your time today. Have a good week ahead. Thank you.
Thank you, everyone.
Thank you.
Thank you.